But look, let's start with a changed outlook for investment markets, both here and around the world. This has been sparked by suggestions of falling interest rates in America. And that in turn sparked the best month for bonds in 35 years, plus a strong rebound by the stock market. And it was all driven by those thoughts that interest rates there are going down sometime soon. But here, though, there are no rate cuts on the horizon. The so-called sticky inflation means at best most economists think rates will remain elevated for longer than expected, most likely right throughout next year. Now, some say it's time the Reserve Bank changed strategy. Instead of hitting households with continued and repeated rate rises, it could look to fix its own house. You see, the Reserve Bank has around $100 billion worth of bonds sitting on its balance sheet, which have between 5 and 8 years in duration to maturity. By selling those bonds, albeit at a loss, it would tighten monetary policy without actually needing it to cut interest rates. Deutsche Bank says if the RBA doesn't act in this way, then our rates and dollar will end up being higher than our economic peers within 1 to 2 years' time. What's clear about that is the outlook for shares, for business conditions, and for the economy clearly will be affected by the next moves by the Reserve Bank. So earlier, I spoke with Morningstar's Chief Investment Officer, Matt Wacher, and asked him about the change in mood on rates.
It's a bit of a double-edged sword because the markets are, they really want those interest rate cuts, bond yields to fall, and we've seen that through November. Equity markets very strong throughout November, but at the same time, they're really pricing in slower growth. And that could start to affect the consumer a little bit more and maybe start to impact some more of those cyclical stocks that have also done well this year.
And your base case for Australia is we do get the soft landing.
Our base case, yeah, generally Australia, the US, even Europe. Europe may already be having a slight recession at the moment, but certainly Australia and the US, a soft landing. Australia, we think, has probably got slightly more risk than the US of heading into a mild recession.
And is that because these interest rates here in Australia are expected to stay higher for longer to try and fight off this inflation?
We think so. I mean, inflation is still a little bit higher here in Australia than the US, although it is falling. We saw that the other day with the CPI numbers. But we think that also the transmission mechanism here in Australia through mortgages is really impacts the consumer much more directly than it does, say, in the US, where people locked in 30-year mortgages, the trade of the decade. The trade of the next 3 decades anyway.
Well, it's funny to say that because the interesting thing is you talk to a lot of people who look at house prices, and this week house prices came out showing this enormous growth since May 2020 when really COVID started to get underway. But a lot of people over that same period of time would have looked at their share portfolios and seen them gone absolutely nowhere. And this is really a common complaint that the equities market has really just not kept up, in particular with the Australian housing market.
Yeah, I mean, that's a really interesting point. I think that there's probably a whole range of structural issues that go on, in the housing market, and migration is a big reason. Obviously rents rising significantly, lots of investor demand still out there at this point in time. But I think that equity markets, or lots of parts of the equity market, 18 months to 2 years ago from this point, were probably getting pretty overvalued. And so they did need that washout in 2022, we felt. There were select areas that were still reasonable value. But what we've seen is that 2022 sell-off really did bring equity valuations back to something more reasonable around this time last year.
OK, so does that mean that there is value in the equities market, seeing as they've gone pretty much on balance nowhere for 5 years? Or is it a case where now you still have to be selective about the sectors and about the individual companies you're buying?
So I would say in Australia, equity valuations have improved reasonably. We're not let's all go all in the Australian market. I think, I think you need to still be selective of stocks. We think that the financials are reasonably valued, although CBA is probably a little bit overvalued. This time, 2 years ago, we would have thought that the Australian market was significantly overvalued. Stocks like CSL and things like that. So it's a chance this last year to be able to go and invest in some of those big names that have come back to more reasonable valuations. In the US, we think that the market's reasonably valued. You can buy financials at reasonable valuations. You can buy small caps at reasonable valuations. It's really just the big stocks that have been driven up by that AI theme the big magnificent seven, as they call them, that are getting back towards quite expensive levels.
I was going to ask you about that, because if we took it backwards 12 months, you would have talked about the washout in the tech stocks and really where their future might be. But the resurgence in Amazon, in the Googles, in the Metas of this world, and then the incredible emergence of the Nvidias off the back of the AI boom. This has really been a part of the narrative of the stock market over the past 12 months.
It has. And if you think back a year, you could have bought Meta at $90 or in the 90s, and now it's trading sort of 300 plus. That was, we thought at the other end of the spectrum that was, the baby being thrown out with the bathwater. At the same time, Nvidia, a lot's got to go right for Nvidia to fulfil its share price. It could well do that. But we think the risk reward there is probably favouring looking at other areas, just because it kind of needs to build another Nvidia to fulfil that share price, which it's a very high quality company, a great company. It could do that. But we think, valuation risk is quite high in some of those names now.
So you've seen, though, here in Australia, with the Australian dollar having been so low, that it's been an attractive hunting ground for, in particular, private equity firms to come and look at Australian stocks, take them off the market. Even our own superannuation funds have been a part of it, if you think about Sydney Airport. So this also becomes a bit of a feature, but it does depend on the Australian dollar and then also the growth potential in those Australian companies.
Yeah, and I think that there's certainly the key thing with especially super funds, private equity funds is private equity funds a little less, but they do have a much more long-term mindset. Super funds are very happy to hold those kind of companies, that Sydney Airport, infrastructure assets that can tick along for many, many years. Private equity obviously want to roll their assets over at some stage, but they do have they're not day trading. They're not kind of just getting washed out with the market. They're certainly coming in and trying to look for long-term investment opportunities. And I think that's what you have to do. You have to look through a lot of the noise that's out there at the moment and think long-term when you're investing in either liquid or illiquid assets.
The one thing about illiquid assets, you talk about commercial property in particular, and if you have a look at that US commercial property market, that did also this year have an impact on the stock market, on many of those REITs that are there, the real estate investment trusts. Here in Australia, we've seen similar things in many of the property-related companies. But as interest rates sort of stabilise, and as we've still got this enormous demand for housing in this country, it seems as though those companies at some stage have got to have a day in the sun.
I mean, it's probably, how long's it been? 10 plus years before everyone hated the REITs after the global financial crisis. Then eventually they loved them. I agree. We're starting to see some reasonable opportunities in the REITs, both here, the US, and even Europe. There's starting to be some opportunities there. They're heavily discounted at this point in time. That doesn't mean that they're at the bottom, but it's certainly worth having a look there. There's certainly good opportunities starting to emerge.
And the one area for Australia that has certainly boomed and flourished has been particularly the alternative metals. So when you go to rare metals, you go to all of those issues, the lithium boom that Australia has seen. And this is, again, go back to the basics of Australia, and why people look to Australia is largely because of minerals.
Yeah, and I think that's a really interesting point. We would say that maybe your BHPs and Rios are a little bit overvalued, and you can look to other areas, other metals. Interestingly, we think that maybe even we have a core allocation in our portfolios, obviously, to Australia, as Australian investors. But interestingly, we'll also look to areas like Brazil, where you can buy some great miners, some great banks, some great financials as well, but at a bit of a discount, an emerging market discount, don't get me wrong, but nonetheless, cheaper assets that are still high-quality businesses. But you're right, there's lots of those the lithium is a key kind of area that everyone's been looking at. We think it's starting to get a little bit overvalued. And if lithium does start to fall, maybe you can buy a cheap electric car someday from the battery perspective.
That might be the little trade-off on the side. I'll tell you, it's a fascinating one to watch. This is always interesting stuff because it just gives people little bits of thoughts about the way in which they'll construct their portfolios. And Matt, I appreciate your time on the program today.
No problem. Thanks a lot for having me.